Hi, and welcome back to the Food Fund, where we analyze investing in food stocks. If you love food and love buying food stocks, beverage stocks, and restaurant stocks, you will love this channel. In this video we will be analyzing if Texas Roadhouse stock is a buy. Texas Roadhouse, stock ticker symbol TXRH, is just one of many companies we explore on this channel. If you are new here, our goal is to help you put your money where your mouth is and invest in the best food companies. We have a lot to cover, so let's go ahead and jump right in. Cue the logo. Let's start with some background info on Texas Roadhouse. Texas Roadhouse was founded back in 1993 in Clarksville, Indiana. They're not just slinging steaks, they are serving up a winning formula. They have successfully carved out a loyal customer base in the competitive dining landscape, serving steaks, ribs, chicken, margaritas, beer, burgers, salads, appetizers, and desserts, with generous portions at affordable prices. With almost 70,000 employees, the company has since sizzled its way to over 627 locations across the US and 10 international markets. Now let's look at the price action. Starting with the 1-year chart, we see that Texas Roadhouse had a CAGR of about 32%. Zooming out to the 5-year chart, we see that Texas Roadhouse had a CAGR of 15%. Texas Roadhouse share price has popped recently against a backdrop of great, consistent gains over the past 5 years. Love this. If we perform a backtest comparison of investing $10,000 in Texas Roadhouse versus the S&P 500, we find some strong results for Texas Roadhouse. In that comparison with the S&P 500, $10,000 invested in Texas Roadhouse would have grown to $25,625 or a 17% CAGR versus $19,709 or a 12% CAGR if invested in the S&P 500. This demonstrates tremendous outperformance for Texas Roadhouse. However, a Texas Roadhouse investment would have been more volatile, with a 29% standard deviation versus 18% for the S&P 500. Texas Roadhouse outperformed the S&P 500 in terms of the best year performance, for which Texas Roadhouse grew 40% versus S&P 500 31%, and worst year performance where Texas Roadhouse fell only 4% versus the S&P 500 18% fall. In terms of max drawdown, Texas Roadhouse fell 38%, more than the max drawdown of 24% for the S&P 500. Nevertheless, Texas Roadhouse outperforms the S&P 500 in comparisons using the Sharpe ratio and the Sortino ratio despite its excess volatility. Now let's hop over to market share and take a look at Texas Roadhouse's market share. So we come over here and type in the ticker symbol for Texas Roadhouse and see that the market share is 0.5% out of the publicly traded food, beverage, and restaurant stocks currently in the market. This means that 0.5% of all money spent for food or beverages goes to Texas Roadhouse. While this is obviously small market share, it has been growing. The 5-year market share CAGR for Texas Roadhouse is 5%. This means that Texas Roadhouse's market share has grown rapidly. If we start in 2019, we see that the market share was 0.4%, fell to 0.35% in 2020, popped back up to 0.44% in 2021, 0.47% in 2022, and 0.5% over the trailing 12 months. Market share growth at Texas Roadhouse continues to be strong and steady. In this newest version of market share, we can actually perform a sub-analysis among a basket of similar companies. For instance, if we want to compare Texas Roadhouse against some of its peers, say Cracker Barrel and Darden restaurants, which own Olive Garden, Longhorn Steakhouse, Ruth's Chris Steakhouse, and the Capitol Grill, we find some interesting results. Out of a basket of those 3 companies, Texas Roadhouse has a 24% market share. Furthermore, we see that Texas Roadhouse grew at a 3% CAGR. This is great news. It means that a basket of Texas Roadhouse, Cracker Barrel, and Darden restaurants grew faster than all food, beverage, and restaurant stocks combined, a nod to the growing shift towards restaurants and away from cooking at home. Additionally, Texas Roadhouse outpaces its peers among this faster growing basket. Texas Roadhouse has been growing market share on both an absolute basis and a relative basis. This is one mighty stock. Let's take a look at the fundamentals. Gross margin is 16%. This is similar gross margin to its peer companies. Revenue has compounded at around 14% over the past 5 years and has reached over $4.48 billion most recently. Customers love this restaurant. Looking at cash flow, we see a 8% CAGR over the last 5 years for operating cash flow, while capex has worsened at a 11% CAGR. As a result, free cash flow has grown at a 5% CAGR. Despite capex increasing as Texas Roadhouse continues to try to grow their footprint, I think the spend represents a good investment in the company's future. This is a great example of growing profitably. Weighted average shares outstanding have fallen over the last 5 years, going from 70.9 million shares in 2019 to 67.2 million shares most recently. Texas Roadhouse has been buying back shares. This is another reason to love Texas Roadhouse. Their commitments to share buybacks is pretty amazing. In fact, about 1% of shares are bought back and retired every year. Now let's view return on invested capital. Return on invested capital has risen from 10.8% in 2019 to 12.2% in 2023. I like where this is going. Texas Roadhouse has become more efficient in driving profits from its investments after this trend bottomed in 2020, onwards and upwards. Another favorite metric is cash conversion cycle, a measure of operational efficiency regarding supplier and payer leverage as well as inventory control. Going from 6 days in 2019 to -4 days most recently, Texas Roadhouse continues to become more efficient over time. A negative value indicates the most efficient use of inventory and supplier and payer leverage. Now, let's look at Texas Roadhouse's debt. The net debt to EBITDA has remained steady over the past 5 years, going from 1.2 in 2019 to 1.2 most recently. While no debt is better than some debt, Texas Roadhouse's debt level is very manageable. Last, let's explore dividends. Current dividend yield is a reasonable 1.8% with a dividend payout percentage of 48%. Texas Roadhouse is paying out dividends that its earnings can support. This indicates that the company's dividend practice should be sustainable. Dividends per share for this company have grown at an 47% dividend per share CAGR over the past 3 years and a 17% dividend per share CAGR over the past 5 years. Looking at the dividend per share chart, we do see a dividend cut in 2020 corresponding with the restaurant shutdown, but the dividend returned in 2021 and has grown nicely since then. The fundamentals of Texas Roadhouse are very good. In any event, should it be added to the portfolio? Before sharing my final thoughts on that, please click the like button and let YouTube know that you like the content. Subscribe and click the notification bell to make sure you catch the latest videos. The channel has grown so much recently, so thank you for your continued support. It really means a lot. Now, let's get into my final thoughts. Okay, let's go to the spreadsheet and write out some key values for Texas Roadhouse. It is a restaurant company with a gross margin of 17%. The 5-year revenue per share CAGR is 15% and the 5-year free cash flow per share CAGR is 6%. This is nice. Steady revenue and free cash flow growth coupled with a good gross margin. A return on invested capital of 12% is okay, but it is growing. Next, the cash conversion cycle of -4 days is just what we want to see. Concerning debt, a net debt to EBITDA of 1.2 means that it would take Texas Roadhouse a little over 1 year of earnings to pay back their debt. So from a fundamental standpoint, Texas Roadhouse is very good. Now let's switch our attention over to valuation. Texas Roadhouse is slightly overvalued relative to the S&P 500 with a ratio of 1.1. The price to earnings growth, or PEG ratio, is 1.2, indicating that Texas Roadhouse is again slightly overvalued relative to their projected earnings growth. Texas Roadhouse has had great growth over the past 5 years as noted by its market share expansion. Management has operated the company in an efficient manner, generating a good amount of free cash flow which they have then used to buy back shares. While we will not know until Q4 2023 results come out, I am pretty sure that Texas Roadhouse took advantage of the October pullback to aggressively buy back more shares. There is really nothing bad to say about Texas Roadhouse. 2020 hit the company hard, but Texas Roadhouse has rebounded beautifully to improve every major metric. For me, Texas Roadhouse is a great example of an excellent company at a fair price. The only thing better is to get an excellent company at a cheap price. For me, Texas Roadhouse for sure is going on the watch list. Many thanks for watching. What do you think about Texas Roadhouse and their rapidly expanding market share? Please share your thoughts below. It is always great to hear from you. Please check out some more videos right now and don't forget to put your money where your mouth is.